Jobless claims coming in lower than expected. That was the catalyst here to the market in pre-market trading. It's easing some of the fears that we saw creep up in the street surrounding recession. Now, this comes following last week's jobs report that really painted the picture, I should say, of a weaker labor market than maybe the street had initially factored in. And that contributed to that massive sell-off that we saw starting on Friday, carrying over into Monday. Many factors, though, contributing to that. So let's talk about what all of this means and where we could be headed for that. We have Kevin Gordon. He's Charles Schwab's director and senior investment strategist. Kevin, it's good to see you. So at least let's start with today's reaction, right? Because we are seeing some optimism maybe return to the market. The jobless claims number there reassuring maybe some skeptical investors out there that the labor market wasn't as weak as maybe initially feared. What's your take?
Yeah, I mean, I think it's definitely probably because it was the only major data point this week. It was a pretty thin week for data. So, I think it's understandable why so much attention has been put on the claims number. Very good, definitely not consistent with, the sort of weakness in payrolls that you would typically see in a recession. Definitely not consistent with even the uptick that we've seen in the unemployment rate. But, to your point about this weakening jobs picture, what was sort of amazing to me, especially on Friday and over the weekend, was this sudden realization on the part of a lot of pundits and strategists that all of a sudden the labor market is weakening. A lot of these trends have been in place for a while, whether it's a slowdown in wage growth or whether it's this drift higher in the unemployment rate or even just the monthly change in payrolls, which has been decelerating. I think probably the miss in expectations for payrolls coupled with that 20 basis point jump in the unemployment rate was probably where a lot of the fear started to kick in. But even if you look at some of the innards of the unemployment rate itself, triggering the SOM rule, yes, a bad thing. But if you start to look at things like the employment to population ratio, even for the prime age group, it's still rising. There's still a lot of inflows into the labor force and it's expanding. So those things are not yet consistent with what you would typically see at the beginning of a recession or the economy already being in a recession. I think that's an important distinction to make, especially because we know that the cycle in many ways has been incredibly unique, especially when it comes to labor. Is the rebound fully in effect at this juncture, or do you think there's more slippage that we could see? I'm not sure we've fully gone through the process of, kind of you get oversold, you rally a little bit, then you have some kind of a retest, and then you get some sort of a breadth thrust. We're probably in the middle of that second and third stage, because you definitely got to oversold in many areas, specifically tech-related and anything, if you're using the sort of the NASDAQ 100 as a benchmark for that. I think the more important story in this entire sell-off has been the fact that there hasn't necessarily been this, outright collapse or weakness, and certainly they haven't been the laggards being the cyclical parts of the market. So even if you go back to the past peak for the S&P, mid-July, the only two sectors that are underperforming the index are tech and consumer discretionary. Clearly there's a consumer weakness play, I think, with the latter, but tech has been definitely the culprit there. If you look at some of the more traditional cyclicals, whether it's financials or even energy, they're still down, but they're still outperforming the index. And of course, there's been a little bit more of a traditional defensive play with utilities and staples doing relatively well. I know Jared was just showing that chart with staples outperforming. But I don't think that if it was this declaration on the market's part that we were definitively going into a recession and the labor market was falling off of a cliff, I think those areas of the market would be doing much more, much worse. So the fact that it's more concentrated in a sector like tech at least tells me that it was part of more maybe of an over-leveraged or overcrowded trade.
Kevin, I'm curious what you make about the reaction that we've seen so far this earnings season, because those that are beating are actually getting rewarded relatively well. Those that are missing, we're seeing this downward pressure. What do you attribute that to? And I guess what does that then tell us maybe about some of the behavior, some of the leadership maybe more broadly that we could then see in the coming quarters? Yeah,
the beats have been rewarded, and I stress the on average part because especially within this earnings season, there's a huge range between, the companies that even if you are beating, some of them are not faring as well, especially if they're not beating on the sales side and if they're not having guidance that's relatively strong. So I think that's probably more important. But even within some of the sectors, and even though we talked about staples outperforming, that's actually been one of the worst sectors so far for companies that are actually missing, whether it comes to earnings or sales, because that's a sector that's been really under pressure from pricing power. And especially with this level shift in inflation now having largely played out, we're still positive year over year and we're still positive month over month for inflation metrics, but it's not as extreme as it once was. And we know that consumers have continued to sort of trade down and be a little bit more selective when it comes to where they're putting their money. So I think you have to be maybe a little bit more granular when it comes to sector by sector or even company by company, because you can get great beats, even in the tech world. A lot of the mega caps that reported, over the past couple of weeks, you can get some really solid data. But if there's a miss maybe on CapEx where they're spending too much, or if there's a miss on what the guidance looks like, then you can kind of get into some trouble, especially when a sector like that has become so highly correlated with the momentum factor this year. Any unwind that you get in that factor tends to accelerate to the downside, and it becomes fairly emphasized to a pretty significant degree. And of course, that's what we've been seeing.
I hope you had your best ginger tea on deck this week, because you certainly needed it. Kevin Gordon, yes. Charles Schwab, Director and Senior Investment Strategist. Thanks so much for taking the time.
Thanks, guys. Good to see you.
Good to see you too.